Okay, chapter 16. Now we're going to move to the investments and international operations. At this point, we're going to see what kind of investments we have. We have two types of investment. One is short-term investment, the other one is long-term investment. Let's see what's the short-term investment. Investment first is you can invest, as you already know from the basic accounting equation, assets equal to liability and equity. You have two options for investments. Actually, only one option for investment. You can invest only and only in equity. If you go with liability, you have to lend money. So that's not investment, that's more like a lending. If you want to invest, you have to invest in the shares. That means in the equity. Shares, what we're going to do with the shares, they can be bought and sold on the stock exchange market. On the stock exchange market, you're going to see the shares or every company which is listed, what is the daily price, what's the change from the previous day, how many shares are currently trading, what's the ratio. Investors and investee, now the investor is the one who purchased the shares, the investee is the one who sells the shares. Now the shares are bought. Why somebody's going to buy shares? Obviously to earn dividend. Or to influence or control another company. Those are the two reasons when somebody wants to invest in another company. So again, remember this, investment, you can invest only in one of the instruments on the other side of the accounting equation. If you buy a liability, that's not investment, that's borrowing. You're on the lender side, lender and borrowing side. So that's a credit. Where if you want to invest, you have to go with the equity. There's no other options. So why somebody wants to invest in another company? First, just to get a dividend. I don't want to get involved in the operation of the company. I just want to have a dividend. Second option is, well, I want full control. I like this company. I have the money. I'm going to buy all the outstanding shares and you'll become mine. Third option, I just want to significantly influence you. So if you buy between 20 and 50% of the shares of the outstanding of the total shares of the company, you may say that you have significant influence. Not necessarily on the advanced financial reporting. If I catch you there, we're going to talk more about this, and you're also going to talk about this in the intermediate accounting 332. But now the chances to catch you there are very minimal. So for that reason, I want you to remember 20 to 50% that represents significant influence in the company, but not necessarily. You have to check other things. And if you have more than 50%, that's considered that you have a control of the company. With 100%, definitely have full control. How are we going to classify the investments? They will be classified as a short-term investment and a long-term investment. What's going to define which one is short-term, which one is not? First, it has to be liquid. It has to be easily converted into cash because the cash is the most liquid assets in the balance sheet. And secondly, they have to be actively traded. If they classify short-term investment, they're current assets. Current assets, every investment which will be converted back to cash within 1 year or current operating cycle of the company, it's considered short-term investment. Long-term investment, now we're going to check the intention of the management. And if the management tells you that they intend to hold the investment for more than 1 year, that's considered long-term investment. So for that reason, accountant doesn't make a decision for this. Management make a decision. So what can happen? It can happen this scenario. You're going to ask the manager, hey, I see you, we buying shares. How long do you intend to hold these shares? And they're saying 2 months. And after 1 year, they still haven't sold them. Is that change it from short term to the long term? No. If the management says that's a short term investment, you keep it as a short term investment. Now, the investment is the debit instrument, obviously. Now the investment in debt instrument. Now we're going with a different direction on the debt. When you go to the debt, now you might it doesn't call investment. It's more like a call borrowing or lending money because you're not expecting to get a dividend. You're expecting to get interest. But those debt instruments, they also categorize either short term and long term. So let's see how we're going to classify the investments. The investments are going to be on the balance sheet. They're going to sit right, if it's short-term investment, they're going to sit right after cash. Why? Because they're liquid and can be easily converted to cash. If it's a long-term investment, it's going to sit after on the first line on the long-term liability, long-term assets in this case, before the property, plant, and equipment. How are we going to classify the investment? We're going to go to and we're going to go and ask the management. For how long are you intending to hold the investment? If the investment says, intend to hold the investment within 1 year, I'm intending to hold it within 1 year, short-term investment. Now, if it's actively traded, let's make it bigger so you can see it. If it's actively traded, that means if there's a stock exchange traded on the stock exchange, we're going to use fair value model. We're going to talk about in a second about the fair value model. If it's not actively traded, if there's no fair value, it means you're investing in the private corporation, then we're going to use historical cost methods. Again, we're going to talk about this. Now, if the management intend to hold the investment for more than 1 year, then become a long-term investment. In the long-term investment, we have three types of investment. First one is without significant influence. You just bought some shares which less than 20% of the voting shares of the company. Then if that happen, we're gonna again check if it's actively traded. If it's actively traded, fair value method. So as you can see, regardless is if short term or long term, as long as it's actively traded, we're using the same method, fair value. If it's not actively traded, we're using historical cost method. So there's no difference between the short-term investment, as you can see here, the short-term investment and the long-term investment without significant influence. Those four scenarios are exactly the same. Now, what's going to happen if we hold the investment for more than 1 year and we have significant influence? Then we have to use the equity method. What if we have a control? Then we have to use consolidation. I'm not going to spend any time on consolidation in this course. Consolidation is taught in advanced financial reporting. So if you have a chance to catch you there, we're going to talk about consolidation there. I'm going to teach you how to do the consolidation. If I don't catch you, the teacher who's going to catch you there, he's going to talk about it. Now let's go to the fair value, because the fair value methods is the one that we're using for the short-term investment, and the long-term investment, which we don't have a significant influence. The fair value method is also called market value method, used for the short-term investment and long-term investment without significant influence. So what that means? That means the investment is initially recorded at cost. Whatever we pay for the shares, that's how we're going to record it. And after that, on every reporting period, we're going to check how much is the fair market value. And we're going to adjust it, the book value, to the fair market value. That's your fair value model. Investment in shares. So what's going to happen? First, we're assuming that this company purchased 1,000 common shares for $16 and they pay 500 commission. Now, the $500 commission that you're paying, that's a pure expense. That doesn't go to the price or to the cost of the investment. So that doesn't change the book value of the investment. So what we're going to do? We're going to debit short-term investments, 16,000. We're going to expense the commission, brokerage commission expense, and we're going to pay cash for everything. That's very straightforward. And now we have a 1,000 common shares, at $16. Now, this investment, do you want me to do this on the Excel spreadsheet or you fine with the slides? Okay, silence. So I'm going to keep with the slides. So when we have a dividend, let's say the company that we bought the shares, they say, okay, we're declaring dividend 25 cents per every share. Since we own 1,000 shares, so we're going to get $250 cash. Once we get the cash, that's going to go directly to the dividend revenue. Next event. Now the share dividend, if we receive the share dividend, so now first one, this one entry is for the cash dividend. But if we receive the share dividend, that doesn't trigger income. But we have to adjust. And we have to make a memorandum that we received a 10% share dividend on the 1,000 shares. Now, on the memorandum, we have to explain what exactly happened and how this is going to adjust the cost for our shares. Because again, we're going to have shares of $16,000, which was 1,000 now, but now we receive 10% dividend. That means a share dividend. That means we get another 100 shares. So that's going to change the cost per share, the book value per share. Now, what's going to happen if now let's go again and assume that now we're selling 400 shares of the company that we purchased. We're selling 400 shares. We're going to receive $20 per share. We still have to pay commission every time when you're dealing with the shares. You cannot directly go and buy the shares. You have to deal with the broker, and that brokers they're usually charging the commission. So we're gonna get the cash. From that cash, we're gonna pay the brokerage fee, and after that, we're gonna reduce our investment account for the 400 shares going down. So we're gonna have only 700 shares left at 14.55, and the remaining is gonna be our gain. So we're gonna get the cash. We're gonna have the brokerage expenses, which we're gonna reduce our cash. We're gonna reduce our investment with 400 shares at 14.55, and we're gonna show the gain on the self-investment, which will be $5.45 times 400 shares. So if we get on the calculation, if you get your calculation, since the $20 is the one that we're selling, but our current book value is 14.55, that give you $5.45 per share times 400 shares, you get again $2,180. That's the other way to calculate the gain. So how are we going to report this one? Accounting standard for the private enterprises, if we're using the equity investment, we have to, on the equity investment with no significant influence, we're reporting in the fair value at the year end. Any gain and losses, it's going to be unrealized gain on unrealized loss. So let's see how this is going to work. We have the shares. Let's go back to the very original scenario when we bought 1,000 shares at $16 per share. So our book value at this point is $16. The year end comes. At the year end, we have to adjust the book value of our shares to the fair market value of the shares. So we're checking the market and we're seeing those shares are currently trading on the December 31st are trading at $18 per share. What that means is that my value of my investment increased with $2 per share. In total increase with $2,000. So what do I have to do? I have to do something about it to adjust to the fair market value. And then we're going to use only in the uh, accounting style of the private enterprises, you're going to have this entry. Fair value valuation allowance, that's a new account, which account is contra account to the investment account. So they're going together, or companion, let's call it companion account, not contra account, companion account. It's companion account to the investment, so they always go together. Fair value valuation allowance, remember it. And we're going to have unrealized gain on the fair value adjustment with $2,000. Why it's unrealized gain? Because we still have the shares in our possession. As long as you're having the assets and the assets change the value, it's called unrealized. A realization comes with the point when you dispose the asset. In this case, the investment. So as long as you're holding the investment, any fluctuation in the market price is going to be considered unrealized until you're actually realizing it by actually physically disposing the asset or in the investment, selling the investment. So we have this fair value, which is again companion account to the investment. How it's going to look like? It's going to look like now on the balance sheet, we're going to show the 18,000. We're not going to show short-term investment 6,000, 16,000. Fair value valuation allowance is 2,000. That's not going to happen. We're going to have in our books on the trial balance, we're going to have the fair value valuation allowance account, but that account never going to be shown on the balance sheet. We internally going to keep it, but for the reporting purposes, for the third parties, we're never going to show it on the balance sheet. Now, what's going to happen if the fair value goes down? We purchase it at 16. Now the fair value of the reporting period is 13, not 18, now it's 13. Well, in that case, we have to show the reduction of the value of our investment. So if we have a reduction, probably that triggers loss. But since we still have the investment, that's going to be called unrealized loss. So on the debit side, we're going to have unrealized loss on the fair value adjustment. And on the credit side, we're going to have fair value valuation allowance. We're still going to play with the fair value valuation allowance account, which account again is companion with the shares. So if the investment is 16,000, but the fair value valuation allowance is 3,000, now the book value of our shares on the balance sheets is going to be 13. It's not going to be 16. So on the reporting period, we're going to show $13,000 on the balance sheet. 16 investment, 3,000 fair value valuation allowance account, which is on the credit side, and that's going to reduce the investment. Now, what's going to happen if we sell that investment? Now it's getting more tricky. I better go to the Excel spreadsheet so we can actually do this one with the journal entries and some calculation. That's my feeling. Correct me if I'm wrong. I better show you this on the Excel spreadsheet so you can get the sense. Let's go with stop sharing this and let's share my Excel spreadsheet. So again, we purchase in the very beginning, we purchase 1,000 shares. So when we purchase shares, we're going to have a short-term investment with that will be and credit. I'm not going to put, okay, let's put this debit commission expense. $500 was, I believe, and $16,000 here investment. No, actually not here. I want it right here, 16, 1, 2, 3, and 500 commission expense, and the rest was cash, credit cash. So we have the investment, and we pay this one plus this one. Now, December 31st comes. December 31st is reporting period. Now, the first scenario was when we have a gain. Let's pretend we have a gain, which means the fair market value of the share is equal to $18 per share. We bought it at 60. Now the fair market value is 8. So in that case, we're going to have debit fair value valuation allowance account, and credit, it's going to be unrealized gain on fair value allowance. On the fair value. I'm going to stop here with my explanation. Let's make it here. And then we're going to have here, since the increase is fair market value is 18, book value is 16. So we have increase with $2. So that means I have a gain, unrealized gain, $2 per share, but I have $1,000, and that's going to be converted $2 times $1,000 is going to convert to 2,000, and that will be my fair value valuation allowances. So when I'm presenting on the balance sheet, I'm going to have investment, short-term investment. Short-term investment. I'm going to have the fair value. Since they're both on the debit side, as you can see, this is my debit. Let's put here debit, and this will be credit. Since both are on the debit side, and I'm gonna even go further here, I'm gonna freeze these panels. Since we're on the debit side, the short-term investment is gonna show 16,000. Fair value valuation is gonna show another 2,000. So how is that called exactly? Let me see. And on the balance sheet, it will be short-term fair value. That will be short-term investment. It will be at fair value. And that's what's going to stay on the balance sheet. And that's the only thing that's going to stay on the balance sheet. I'm going to highlight it for you. So this amount here is the 2000. And the fair value will be 18,000. And that's, those two together. And that's the only thing that's going to appear on the balance sheet, nothing else. Now, this scenario, assume, let me copy from the slides the scenario with the gain so you can have it. So the first one was this, copy. The very first one with the purchase. This is the purchase of the investment. Then we have a gain, scenarios with the gain. Let's insert those one. The scenarios with the gain will be a little bit down. Find it quickly. This will be the scenario with the gain. And now we're in the scenario with the loss. So now for the scenario of the loss, I can easily copy this and move it here and work with this one. Again, December 31st, but now I have loss. How am I going to find out? Because the fair market value for me is $13, but my book value is 16. So I have reduction of $3. So in that case, I'm not going to have unrealized gain. I'm going to have unrealized loss on fair value, which in this case is going to be equal 1,000 times $3. And here I'm going to have the fair value. Let me copy it from here. Fair value valuation allowance with the same amount, which is $3,000. Now, what's going to happen on the balance sheet? On the balance sheet, I'm going to still have the short-term investments. There will be 16,000. So now I'm going to check. Where am I? Now I have the short-term investment in the very beginning. When I purchase it, I purchase it for 16. Now I have unrealized fair value now going on the credit side. So my short-term investment on the debit side, my fair value is on the credit side. If it's on the credit side, that means that's going to trigger minus. And that will be not that cell. That's going to be this cell. So my short-term investment at fair value is going to be shown as a $13,000 on my balance sheet. Now let's see the scenario. So this one was the gain. Let's make it gain. Let's call it green. This is the loss. There, that's going to call it on the blue side. The next thing that's going to happen is we're selling those shares, but we're not selling everything. We're selling only, let me see, where was that entry with the sales? Okay, here. The last scenario is we're selling the investment. On December 31st, once we adjusted it to 13,000. So now my balance sheet shows this. I have the short-term investment. I have unrealized loss. The short-term investment is 16,000. My unrealized loss is $3,000. I have this as a starting point for the last entry. which is, let's push it a little bit down. Now on January, that's on December 31st. December 31st, I have this one as a balance sheet. On January 19, I'm selling it. And I'm selling it for $12,000. So let's see, debit. What I'm gonna get? I'm gonna get cash, and I'm gonna get $12,000 cash. As you can see, there's no commissions here. We're not messing. I'm not gonna mess your head with the commission and anything like that. So my debit here will be $12,000. But I have two accounts to get rid of. I have to get rid first of the unrealized loss. Second, I have to get rid of the short-term investment. What's the tricky part? The tricky part is the short-term investment has a debit balance, unrealized loss has a credit balance. So let's clear those one. First, I have to debit unrealized loss, $3,000. Then I have to eliminate the short-term investment because I sold everything. Short-term investment, that's gone. 16,000. Now I'm chasing on which side I'm short, on the debit side or the credit side. As you can see, I'm short on the debit side. I need 1,000 more. If I need 1,000 more, debit is related only to the loss of sale of short-term investment. And that loss is $1,000. So I'm losing. If this is the case when I'm losing, loss at selling point. Is it possible we to have a gain? Of course. Let's see the scenario when we have a gain. What's going to happen if we have a gain? Let's go with this one. Let's mark it in this color. If you want to see that we have a gain, we have to change a little bit, and let's say here, instead of 12,000, I'm selling this investment for 20,000. So let's come here with the scenarios. So on December 31st, we are adjusting the carrying value of the of 13,000. So basically, this is our starting point again. I'm gonna adjust it right. That will be gain at selling point. Now let's uncolor it, and that will be my short-term investment. This will be my unrealized value, and that will be my short-term investment, and that's gonna be unrealized. No, that's not unrealized. That's gonna be here fair value valuation allowance account. That's what I'm chasing here. This will be fair value valuation again, and this one will be fair value valuation. So in this case, in here, yes, now the entry is fine. So in this case, I'm getting 20,000. So on January 19th, I'm getting cash, debit cash. But then next time I'm getting $20,000. Again, first I have to get rid of the fair value valuation allowance. And I'm getting rid of it, which is $3,000. Then I'm getting rid of the short-term investment. And the value of the short-term investment is 16,000, that's gone. And now I'm chasing on which side I'm short. I have 23 here, I have only 16 here. I have to add more. So that will be this one plus this one minus that one. and that's 7,000. And 7,000, since it's on the credit side, I'm going to have a gain on sell of short-term investment. And now you have all the scenarios. Everything possible. The purchase on the reporting date, the value goes up. On the reporting date, the value goes down. Selling at loss, selling at gain. That's with the short-term investment, short-term investment. Let's go now for the next part. I have to go one back because I changed it here, the scenario. So, and let's see what we're gonna do if we're doing the short-term bond. On the short-term bond, the only thing that I want you to understand, we're gonna use the fair value method, and the premium and discount, those are not amortized, and that's all. Let's move to the long-term investment. Long-term investment, as we talk, we have the investment. It's long-term when the management says it's a long-term. We're going to ask the management. If the management intention is to hold the investment for the long term, it's become long term. Now, here says the investment is understood to be long term unless specifically labeled as a short term. Again, who's going to decide what to management? Long term investment without significant influence. First, long term investment that will be in shares, since it's equity, is in share on another corporation. Why are we doing this? We want to get a dividend. And we want to make a profit by sharing when the market price goes up. We don't have significant influence. That means we own less than 20% of the voting shares. Because of that, on the day, there's no changes between short-term investment and long-term investment without significant influence. Everything that applies for the short-term investment apply to the long-term investment without significant influence. We're gonna, on the day that we purchase the shares, we're gonna use the cost, the actual cost. When we receive the dividend, that's gonna be dividend revenue. Every year, at the end of the year, of the reporting date, we have to adjust to the fair value by using the unrealized gain and losses and valuation allowance account. And that's all. So everything that we just did for the short-term investment, the same thing we're going to do with the long-term investment without significant influence. So as soon as you see I own then less than 20% of the shares, treat it as a short-term investment. No difference on that one. And that's where we're going to stop with this one. Do you want break?
Yes, please.
Yes, bro.
Okay, let's go for 10 minutes break, and I'm going to catch you after.
Thank you, Professor.
Thank you too. All right, people. Are you ready?
Yes.
Let's go then. Let's finish this chapter. Now, again, for the short-term investments, let's start the recording. For the short-term investments and long-term investment without significant influence, we're using the same method, fair value method. Means at the time when we purchase the investment, we're gonna use the actual cost. Every time when we receive the dividend, we're gonna have a dividend to revenue, cash dividend. And every time when we have a reporting date, if there's adjustments, if the market value move, we're gonna adjust our balance sheet to the fair market value of the investment. That's why it's called fair value method. Doesn't matter how the market value changes, our books on the reporting date always shows the actual value of the investment. Now let's move to the next method, which method is called equity method. Equity method is used when we have a long-term investment, share investment, and on which we have significant influence. What means significant influence? Significant influence means if we hold 20 to 50%. Now, on the significant influence, we're going to see in advanced financial reporting, which is called Q1 course, different variations and more explanation about the significant influence in the lights of the International Financial Reporting Standards. But for the accounting standard for the private enterprises, you should remember 20 to 50%, and the investor has significant influence in the decision making of the investee. How they record it? Initially, they record it at cost. Later, we're using the equity method. Now, what means equity method? We're going to see now. So, imagine this company pays $4 million for 30% of the common shares, and they pay brokerage expenses, commission for that. Now, the money that they pay for the brokerage, the direct expense. Investment become investment. So I'm gonna get this one and I'm gonna flip to the Excel spreadsheet again, because we're gonna create a new part of the Excel spreadsheet, which will be dealing with the equity investments, short-term investments, and let's call it here fair value method. And we're gonna have a new thing, which will be long-term investment, equity method. And let's see now what's this equity method, what's so different. What's so different about this equity method? Gonna delete all those, I don't need this one, but I'm gonna use the setup. Don't get me wrong, I'm gonna delete everything, but I'm gonna use the setup. First we're gonna no fields, then we're gonna delete everything, and then we're gonna move all the lines and everything, boom, done. So now I have my Excel spreadsheet ready for me. So again, this company pays $4 million for 30% of the common shares of the company, pays the brokerage commission. So debit in this case will be for the investment. We can call it long-term investment or investment in this corporation. Investment long-term and the company name. So they invested $4 million. 1, 2, 3, 1, 2, 3. They paid commission expense of $5,000, and they pay everything in cash. Investment, long-term investment, common shares. We can put here common shares, and they pay cash, this one plus that one. And that's it. That's our journal entry. On the purchasing date. Again, on the purchasing date, we're using the cost method. Whatever the cost is, that's how we're making the journal entry. Now let's see what's going to happen next. Next, under the equity, for what we have to remember, under the equity method, records the shares of investee, net income at 30%, and dividend declared at 30%. So example, if the net income of this company investee is reported to be $1 million, our investment is going to increase with 30% of $1 million. So what's going to happen? Let's go to the Excel spreadsheet. I'm going to copy this and I'm going to go to the Excel spreadsheet. Let's share my Excel. So again, we purchased this company. We purchased 30% of the common shares of this company. Now, later on, this company, the one that we purchased 30%, they're saying, you know what? We're declaring net income. Well, that's very good. But don't forget, I own 30% of your shares. That means 30% of your income is my income. In that case, we have to show this one as an increase in our investment. If the other company make income and I own 30% of the shares, that means 30% of their income belongs to me. So what I'm going to do, debit investment in the long-term common shares of the company. And I'm going to take, since they're declaring 1 million, that means, and I owe 30%. So 1 million, 1, 2, 3, 1, 2, 3 times 0.3, it's mine. Now, what's this going to be for me? For me, that's going to be purely equity method investment revenue now. That's where the trigger point of the revenue is. Then I'm going to, later on, going to make a comparison between the short-term investment and the fair value market method and the equity method, so you can see exactly the differences between one and the other. Credit will be, in this case, what we said. We said equity method investment revenue. And that will be exactly the same as a debit amount. Next scenario is, as we're gonna project or predict, the company is gonna declare a dividend. This is to record. Let me show you. Let's paste this one first. First one is to record the purchase. To record the purchase of investment. And we record the purchase of the investment. Let's mark it here with blue. Next one is to the investee net income. And we're recording the investee net income. Investee make income, that means income for us. Next one is to declare, to record the dividend from investee. Now the investee or the company decide to declare cash dividend. Very good. How much of the common shares we owe? We owe 30%. So 30% of the dividend belongs to us. So let's get it. Debit, cash, and we're gonna get, here will be 600,000 times 0.3%. We're gonna get 180,000. Now, the tricky part, watch this now. For the equity method, every time when we get a dividend from the investee, that reducing our investment. So the credit is going to go to the investment in the long-term common shares. And our investment is going to go down with $180,000. So what we can conclude from this one, only from those two transactions, is every time when the investee generate income, that increasing our investment. And every time when the investee pay dividend, that decreasing our investment under the equity method. So now let's go back to slides and let's cover those slides so you can see it on the slides. So what's happened here? Again, we invested in the company. What was that? We invested in the company, we paid the $5,000 brokerage, and we paid the cash. Later on, the investee shows that they have $1 million income. 30% of that income belongs to us, so that's going to increase our investment. And we're gonna record it as our revenue. This is the revenue trigger point for us when the investee generate income. Then later on, the investee decide to declare dividend. Well, we're gonna get the cash, but that's gonna reduce our investment. So now let's see what's happened in our equity account. We purchase it for 400,000, for 4 million. Investee reported income, 30,000 going to us to increase the investment. But the investee paid the dividend. So that's going to reduce our investment. So our investment at the reporting date, December 31st, is now $4,120,000. So again, net income from the investee increasing the investment for the investor, and the dividend from the investee reducing or decreasing the investment in the investor. Next one, let's see what's going to happen if we sell our investment. Let's see here. I'm going to copy this and I'm going to go back to the Excel spreadsheet. Let me see where's my I have to stop sharing this and let's go to the Excel spreadsheet. And let's paste this one here. A little bit adjustment before we go to this point. The adjustment was to match the T account that they make for the investor. Let's make this T account right here. I know it's a little bit wide, but doesn't matter. And it's gonna be like this. So we have the initial investment. Then we're gonna have the investee income. And we're gonna have investee dividend. So our initial investment was 4 million. That's our debit. And that's our credit. Then we're gonna have from the investee income, which flowing to us, increase in the debit side is 300,000. And the dividend that we receive 180,000. So our ending balance on December 31st, ending balance for our investment, that will be called investment long-term common shares of the company. Our investment ending balance, that if you want here, we can put the beginning balance, put the beginning balance here. Beginning balance obviously is 0. So let's make it like this. And then the ending balance is going to be beginning balance plus the debits minus the credits. And it's going to give you the current balance on our investment long-term shares. Now, the next thing that's going to happen is we're going to sell 1/10 of the shares for $400,000. So we're selling 1/10. So let's see what's 1/10. 1/10 is 10%. How much is our investment? 4,120,000. How much is the 1/10? So how much we selling? So we're selling this one time 10%. That's how much is gone. How much we get? We get, let's see, we get, I'm gonna do two entries and then I can combine it into one so you can understand it. Debit, we're gonna get cash and we're gonna get cash $400,000. Sorry, not in this line, in here, 400. Why are we getting cash? Because we don't have we're selling the investment. Let's reduce the investment. Debit, that will be credit, investment on the long-term common shares. And how much is we selling? We're selling 1/10, which is we're selling 140. Now we are short on the debit side. So that means we're losing debit. We're selling for $400, something that's worth 412 in our books. So we have loss on sale of long-term investment in common shares. And that loss is exactly this one minus that one. Now, on top of that, we have to pay brokerage fee. So that will be debit, brokerage, fee expense for $500, and we have to pay it cash, $500. That's if you have to do it with two entries. Now, if you want to use one combined entry, then you can simply do debit, cash, debit, brokerage fee expenses, debit, loss on the sales of long-term investment, and credit, investment in the long-term on the common shares. And then we're gonna get cash. How much cash we're gonna be? We're gonna get 400 minus 500. That's the cash that we're gonna get. We're gonna have the brokerage fee. We're gonna have the loss, and then we're gonna have the investment. And now that's how we balance each other. So if you want to do it with one entry, you have to combine those two entries. I'm showing you different alternatives so you can see how from two entries you can move to only one entry. Either way is okay. And that's your scenario when we selling the investment. Now, if you want, I can do comparison here. Let's do one short quick comparison between fair market value method and equity method. So how many events we have? We have 1, 2, 3, 4, 5 events, I believe. Let's go with the events. So I'm gonna delete everything here because I don't need this one. Actually, not like that. I'm gonna delete it like this, and then I'm gonna remove no fillings and clear from all the borders, and I'm gonna delete those one as well because I don't need this. So debit and credit here, and I'm gonna have the same thing right here, debit and credit. I know I'm gonna spend a little bit more time, but I want you to understand this because this, I hope this is gonna stay with you for the long period of time once you have it here. That will be the fair market value method, and this one gonna be equity method. First event here, let's make it like this, and let's make it like this. First event is, I'm gonna put it, is the original initial purchase. On the initial purchase date, in both methods are the same. Debit, investment, either short-term investment at cost. Debit, brokerage fee, expense, credit cash. Sorry, this one will be credit here, and the credit's gonna go cash. So debit, you're gonna have here debit, you're gonna have here debit, and you're gonna have here credit. They're all the same. There's no difference. So the only difference is here, instead of short-term investment, you're gonna have a long-term investment. That's the only thing. Second one is let's go with the income, net income reported by investee. Under the fair market value, there's no entry required. No entry. Not applicable or not applicable. Where in the equity method, you have to show the increase of the investment. That will be debit, long-term investment. And the credit, it's going to go with the equity method investment revenue. Equity method investment revenue. Increase here and increase on this side. Now the next event, those are the events. First event is this one, second event is this one. Next event is the investee declaring dividend, cash dividend from investee. Now on the cash dividend, in here, both methods have the same journal entries. Here we're going to have debit, cash, credit, actually it's not the same. Now we're going to have dividend, investment income, revenue in this case. And here I'm going to get my cash. And here I'm going to show my investment revenue. Where on the equity method, now watch this, on the equity method, there's no revenue here. The dividend when you're going to receive is going to reduce your investment account. That's for the cash dividend. Next event is reporting date. Year end, go year end reporting date. On the year end reporting date, on the fair market value, we have to adjust our investment to the market value. So basically what we're going to have debit. Either we're going to have debit short-term investment. No, actually, no, I'm sorry, I'm not playing with, we're going with the fair value. Let me copy this here. We're playing with this account here, fair value valuation allowance. V. Let me grab it again. Fair value valuation allowance. And if it go on the debit side, then we're going to have credit here. That will be unrealized gain on the fair value. On this side and this side. Or the opposite. We're going to have a gain, loss, sorry. The other option is to have an unrealized loss. We're going to have debit loss on the fair value and credit will be fair value valuation allowance. Again, on both sides. Now on the equity method, at the year end, no entry. And here again, no entry. It's not required. Why? Because on the equity method, we already adjusted our investment to the current value of the investment. The last event is the selling of the investment. In the selling of the investment, now here, don't forget, we have two scenarios here. Either we're going to have loss. Let me call this one here, V. I'll see, and either we're going to have this scenario. We're going to get the cash. We're going to clear the fair value valuation allowances. We're going to have the loss, and we're going to have a short-term investment. Either we're going to have a gain. In this scenario here, let me see this one, but I'm going to eliminate the brokerage fee. In this case, again, either we're going to have gain, either we're going to have loss. So sorry, that's I want to paste it like this. But again, I'm going to eliminate the brokerage fee just to be simple. And that will be XXX, XXX, and XXX. or gain. And those are the scenarios. I want you to, once I post you this chart, I want you to keep it. Because this simply explains what's the difference between the fair value method and let's put it this way, and the equity method. Let's put it this way. And you have everything available here in one chart. The only thing that you have to do is to prepare for yourself the scenario with the gain. That's all. And you have the journal entries and you have everything. And if you follow this, you're never gonna make a mistake. You can trust me on this. Make sense? It's your choice how you're gonna use this. You have it available. Now, the next thing that left on this chapter is the easiest part. On the consolidation financial statement, I told you that's dealing with the advanced financial reporting. I'm not gonna steal. The only thing that I want you to know is if we invest more than 50% in the common shares in the company, we have a control. When we have a control, we have to do consolidation. What we're gonna consolidate? We're gonna consolidate everything, all the financial statements. Here we have different scenarios of the control. So we're going to consolidate balance sheet. We're going to consolidate the income statement. And from the balance sheet and income statement, we're going to prepare cash flow statement, which we're going to see next time. And this is the summary of the account of the investments. So if you have short-term, no significant influence, fair value method. Long-term, no significant influence, fair value method. No significant short-term, no significant historical method. Long-term, non-significant historical method. Now, if you have significant influence, then you're going to use the equity method. And when you have a control, you're going to do consolidation. What's the differences? I already show it to you. And one chart, Excel spreadsheet. Now, investment in the bonds. Can we invest in the bonds? Yes, we can. Now, on the investment, the long-term investment, short-term investments, there's no amortization. The long-term investment, we have to record it as a cost. And then we may have amortization or discount on or premium. We already talked about the investment when we issue the investment. So, on the bonds when we issue the bonds. I'm not gonna waste your time here. We going to the investment in the bonds. So the bonds not gonna be examinable. You don't have to worry about the bonds. The last thing that left on this chapter is the foreign currency transactions. And we have only two types of foreign currency transactions. One is the purchase, the other one is sell. Why we have the foreign currency? Because some of the company dealing with the international companies which are not dealing with the Canadian dollar. For that reason, we have to transfer the Canadian dollars into another currency. And that's how we're going to be exposed to foreign exchange rate, which foreign exchange rate is the price of one currency measured in another currency. So the transactions related to the foreign currency, it must be translated into the Canadian dollar before they're recorded. Now the translation will be using the exchange rate to convert one currency into the reporting currency, which will be Canadian dollars for us. So again, we have two events. First, we have to pay in foreign currency. Second one, we have to receive cash in foreign currency. So let's see first one, when we purchasing. If we're purchasing in foreign currency, those has to be translated in the Canadian dollar. For example, we buying perfume from the French supplier, which costs 75,000 euro, but the exchange rate for euro is 156. Now, the tricky part here is if we pay right away in cash, Deal is settled. The problem is we're not paying cash. We keep it as accounts payable. Now we have this accounts payable, which accounts payable is $170,000. Now what's going to happen now? That exchange rate is going to start to fluctuate. So first we're going to have a reporting date. On the reporting date, we have to see how much is the current value of those 75,000 euro that we have to pay. So we're checking the exchange rate, and we find out that originally was 156. Now on the reporting dates went to 157. So we're losing 1 cent per euro. So 750,000 for 50 euro, we're losing. So that means our accounts payable is going to go up, going to increase with 750, and we're going to show foreign currency transaction loss. That's on the reporting date. Then coming the payment date. On the payment date, now we have to convert those 75,000 euro into a Canadian dollar again by using the exchange rate. And we see the exchange rate here is 158. So increase with another cent per euro. We're buying it 75,000 euro times 158. We're buying $118,500. So we're using 118,500 Canadian dollar to pay the 75,000 euro. We're closing our payables, which at December 31st, we increased to 170,750. We paying Canadian dollar 180,500, and that triggers another $750 foreign exchange loss. So because we paying late, we lost $2 for every euro that we pay over this period. Now this is for the paying. Now the next thing is going to happen when we selling. Now imagine we selling to the American company. We selling products for $440,000. The exchange rate is 1.004. So our accounts receivables, we have to receive 145,600 Canadian dollars, which represent 140,000 US dollars and 114. Now we're going to have next event that we're going to have is the actual payment. On the payment date, it turns out that the exchange rates change, not in our favor. So when we receive the US dollars, we have to convert them into Canadian dollars. But when we do that conversion, we're getting only $142,800. But those $142,800, they have to close accounts receivables of $145,600. And that triggers that loss on the foreign currency transactions. Now, to minimize the risk, we can hedge. On the hedging, you can finances people, they're going to explain about hedging and how to mitigate the loss of the fluctuation on the foreign currency transactions. And the last thing left on this chapter is the comparison between the accounting standard for the private enterprises and the International Financial Reporting Standards. But since you don't know International Financial Reporting Standards, I'm not going to spend your time on this one. So remember, for the foreign currency operations, you have two events. When you have to pay in the foreign currency, and the other event is when you have to receive foreign currency. And because the payment date is not on the date that you purchase it, and the time passing, that's why you have a fluctuation of the foreign currency. And the same thing with the receiving date. The date of the sale that you're selling it is not the date that you're receiving the cash. There's a delay of time. For that reason, there's a fluctuation in the foreign currency. And that's about for this chapter. Questions? Any questions, people?